Welcome to Chapter 8 of the Wealth Management Essentials course. This chapter is all about understanding tax returns. There are 4 different learning objectives in this chapter. We will be talking about financial planning and taxation, as well as personal income tax return, taxation of investment income, and taxable and non-taxable employee benefits. So we're going to start by talking about financial planning and taxation. When you are creating a financial plan for a client, it is important to be aware of different tax rules and implications. One thing that you should always try to do is eliminate tax when possible. So taxpayers can structure their affairs certain ways to avoid paying taxes using investment vehicles such as TFSAs or FHSAs in some cases. You'll also want to try to reduce taxes, so taxpayers can adjust their situation so that a lower tax rate is applied to their earned income. For example, pension income can be split between spouses to save the household some taxes. RSPs also allow people to defer taxes with the idea of getting an RSP deduction in a high tax bracket, usually when they're working, and then receive the taxable income from the RSP when they are in a lower tax bracket, usually in retirement. So it is important to be aware of these different strategies and to try and implement them when creating a plan. Deferring taxes is also quite important, so taxpayers can put off paying taxes to take advantage of lower tax rates in the future. And you can do this through buy and hold strategies in non-registered accounts with equities and also saving inside of RSPs. So now looking at the personal income tax return. Canadian residents are taxed on income by both the federal and provincial governments. Non-residents may be taxed on income generated from certain Canadian sources. So taxpayers, they may receive several types of tax slips depending on their investment accounts. They may receive a T3 slip, which lists income such as interest, dividends, and capital gains distributed to investors holding mutual funds in non-registered accounts. T4 slips, this is your total compensation paid to an employee. So if you are an employee, you will get a T4 slip that you will have to use with your taxes, just reporting your employment income. T4A is the amount paid from pension plans, annuities, scholarships, and RESPs. A T5 slip, it reports interest, dividends, and capital gains paid to individuals holding corporate class mutual funds. So if you do have a non-registered account, you could get either a T3 slip or a T5 slip. The only difference is the T5 slip is from a corporate class mutual fund. There is also a T5008. It reports the amounts received from the disposition of securities for taxable accounts. Now we're going to take a look at how taxes are calculated. So first, you calculate the total income from all taxable sources. Then you can calculate the net income by subtracting allowable tax deductions. So this could be like RSP contributions, registered pension plan contributions, union dues, childcare expenses, moving expenses, employment expenses if you are self-employed, just any tax deductions that you do have. Then you can calculate the taxable income by just subtracting all of these deductions from the net income. Once you have the taxable income, you can calculate the taxes owing by applying federal progressive tax rates, and then calculate the refund or balance owing by comparing the net taxes owing to the amount that you already paid the government. So you will see on your paycheck, you'll notice that part of your pay is being withheld to tax. And so at the end, if you have withheld more than you needed, you get some back. If not, you have to pay some more in. So I just want to go through a quick example on how tax rates work. So with tax rates, it sort of is a tiered system. So say if someone made $100,000, well, on the first $50,197, it would be taxed at 15%. Then the next portion of income, so that would be any income above that $50,197, would be taxed at 20.5%. So it's not like all of the income is taxed at the highest rate. You are taxed as you increase up the tax bracket. Now, I just want to go over some different tax deductions. So as I mentioned, contributions to a registered pension plan or an RSP, they are considered tax deductions. So you can deduct that from your gross income to figure out your taxable income. There's also deductions for elected split pension amounts, union and professional dues, childcare expenses, business investment losses, moving expenses, eligible support payments, also some carrying charges or interest expenses if they are being used for business purposes, and other employment expenses as well. Now, there is a key difference between tax deductions and tax credits. Whereas with tax credits, it is deducted from the amount of tax owing. So you might have certain tax credits. There's the pension income tax credit that you can get at age 65. There's an age credit that you can get based on a certain age. But there are various different tax credits that you can get. Of course, there's different eligibility requirements for each one, but you can see just a list of some different tax credits that you may come across when looking at a client's situation. Next, we'll take a look at taxation of investment income. So if you do have a non-registered account, you will be taxed on the growth of that account. So if you do have an investment that is earning interest or foreign dividends, then it is fully taxable. So this could be from something like a bond, a GIC, a mutual fund, any sort of investment that pays interest income, and so it's fully taxable. Also, if you own a foreign stock that pays a dividend, that dividend is fully taxable as well. Now, if you do have a Canadian stock and that Canadian stock pays dividends, it is taxed at a better rate than interest. It is a bit complicated, but eligible dividends, which is a dividend from a company that has made over $500,000 of profit. So basically any Canadian stock on the TSX, if they do pay a dividend, it is going to be eligible. What they do is they actually gross up that dividend. So say you got a dividend of $1,000, well, they gross that up so by 38%. So it actually shows on your tax return that you made $1,380. But then they take a dividend tax credit from that. So I believe they take about 15% of that 1,380 number, and they give you a tax credit. And so overall, the bottom line is that it is a lower tax rate than interest, and it's fairly comparable to capital gains. Usually capital gains is a bit better, but it does depend on your tax rate. So capital gains, it is another way to earn some taxable income in a non-registered account. It's pretty simple. If you do buy a stock for $1,000, for example, and sell it for $2,000 a few years later, you would have a capital gain of $1,000. Only half of that is considered taxable. So there is an inclusion rate of 50%. This could change in the future, but right now it's 50%. So you only have to claim $500 of taxable income or a taxable capital gain. Also, capital losses can be used to offset capital gains for tax purposes. And finally, you do have return of capital. So occasionally, mutual funds may make a distribution in excess of their taxable income, and this is essentially just a return on capital which isn't taxable. And finally, we'll look at some taxable and non-taxable employee benefits. So certain taxable employee benefits include a home purchase and relocation loan. So this taxable benefit is determined based on the difference between the interest rate payable and CRA's lowest prescribed rate. Also, interest-free loans are taxable. So if your employer is giving you an interest-free loan, that's considered taxable income. Deferred compensation, that's also taxable income, and a retirement allowance is taxable. Now we'll just look at non-taxable benefits. So this would include health and group life insurance. The employer can actually deduct the premium as well, but it is not a taxable benefit to the employee, which is sort of the exception to that rule. Business meal and entertainment expenses, they are non-taxable. Employer paid courses for employees, reimbursement of an employee's moving costs, and club membership. And then mixed, so sometimes it's taxable or sometimes it's not taxable. So reasonable car allowances are non-taxable, but allowances in excess of a reasonable amount must be reported as a taxable benefit. So car allowance, it sort of depends. Personal use of a company car, same sort of thing. Employee stock option plans, so this gives the option for the employee to buy a company stock at a certain price. And so this is sometimes a taxable benefit. And finally, we'll look at disability insurance. So disability insurance, the benefit is only taxable if the employer paid the premium. If the employee paid the premium, then the benefit is non-taxable. And so those are all of the main components to Chapter 8. I really hope you found this review helpful, and I will see you in Chapter 9.